Hey, Cashflow Ninjas, real quick before we jump into today's episode. I've been asked by many people recently, what has been the one thing that has made all the difference on my journey as a business owner and investor? I started businesses and I've invested in businesses. I've invested in single family real estate, multifamily real estate. I still have a sizable portfolio of multifamily real estate, historic resorts, mobile home parks, oil and gas, life settlements, gold and silver, Bitcoin and cryptocurrencies. I could go on. But the one thing that has changed the financial trajectory for myself and my family has been infinite banking. Yes, you heard that correctly. That is the number one thing I've done over the past 2 decades that have made the single biggest difference. And it's not even close. Setting up and building out a family banking system using infinite banking has enabled me to create my own financial system. This year, it has allowed me to focus and not pay attention to all the chaos in the global economy and global financial markets. I really don't pay attention to all the noise about tariffs, trade wars, markets violently going down and then going back up, or interest rates skyrocketing and wrecking real estate deals and other alternative investment deals. Do not be beholden to other systems. Create your own system. If you're interested in working with me and my team at Producers Wealth to set up your own banking system or your own business and family banking system, then go to getwealthyforsure.com. That's getwealthyforsure.com. When you go to getwealthyforsure.com, you can request a free copy of my best-selling book, Get Wealthy for Sure. Only pay for shipping. You can also watch all of our presentations and schedule a call to explore infinite banking options with me and my team. You don't have to be powerless amidst the chaos. You too can have a financial strategy that provides certainty, predictability, and clarity. You and your family can also get wealthy for sure. Go to getwealthyforsure.com to start your journey today.
The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Laubscher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for joining me for another episode and spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. We've got over 1,000 podcast episodes, 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the best newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. I've got a fantastic show for you today. I'm joined by Michael Mathe. Michael Mathe is an entrepreneur, an investor, and is also involved with a fantastic financial education platform and channel on YouTube called VIP Financial Education. Michael's been a guest on the show several times. He always brings a ton of value to all of my listeners and viewers, and he has shared some incredible information of what he's doing currently in this specific time period of the market cycle. So, back by popular demand is Michael Mathe. Michael, great to see you.
Yeah, great to see you, MC. How are you?
Fantastic. I've been looking forward to our conversation. I always appreciate our conversations, the ones that are not recorded, the ones that are recorded. So I always learn something and pick something up. And, for our show too, you're back by popular request. A lot of people have reached out on the episodes that we have done and asked, hey, can we do another episode with Michael and kind of see what's going on in his world? But before we do, we have a lot of new listeners and viewers. By the way, if you're a new listener and viewer to the Cashflow Ninja podcast, go to cashflowninja.com and just type in Michael Mathe, and you'll see all of the previous interviews that we've done together. He always provides a ton of value. You can learn from every single conversation that is at cashflowninja.com. But Michael, for the new listeners and viewers not familiar with you and what you do, could you please share a little bit about your background and journey?
Yeah, absolutely. So I'm a lifelong entrepreneur. After I graduated from college, I started multiple businesses, grew and sold a couple of those, and in my mid-20s really became full-time in the real estate investment space. So over the last 25 years to date myself, I'll be 50 coming up here in January.
Nice.
I've been a full-time real estate investor. I've had a few specific businesses and a few models that have really worked out well for me. I've got a YouTube channel myself that's VIP Financial Education. We've had you on there a number of times. Our audience loves you just the same to talk about, your story and everything that you're involved in. But primarily, I'm an operator. So I'm an operator in the luxury real estate investment space. I've got a model that's called Prefer, and Prefer is an acronym for Passive Real Estate Flips Easy Returns. It's kind of a quasi syndication model. It's an alternative investment model that a lot of investors that love real estate, they want to get involved in real estate, but they don't want the financial exposure to do a deal by themselves, and they certainly don't have the experience to go out there and be an operator. So they come into our database and they participate in deals like I'm doing all the time. I operate in Florida. It's where I live, in Ponte Vedra Beach. I'm actually at a new house that I just picked up down here in West Palm Beach. So a couple of the hottest real estate markets in the country, right here on the east coast of Florida. And I work with folks that are all walks of life. I work with some professional investors. I work with some accredited investors. I work with folks that are just kind of mom and pop newbie investors to the game, and provide them with a blueprint really to be successful investors in a passive model, which is what I offer.
Awesome. One of the things with all of your business just ventures, and this is one thing that I'll say from having known you for a very long time now, is you look at the environment and you adjust accordingly. So you're not a one-trick pony, which if you to be successful and have sustained success for 25 years, that's what you got to do, right? You got to see what's out there and make adjustments, but you have always played in the luxury space. So maybe just some comments on that about the luxury space. That's where you operate in and why you prefer that, and also the importance of making adjustments as things are changing.
Yeah, so to your point, I always do try and pivot based on what the market conditions look like. It's always going to be in real estate. It's always going to be in high-end real estate, but I'm typically doing what I'm looking to see what most other folks in my space are doing, and I'm doing the opposite of that. I'm running away from the masses. I'm running away from where the big crowds are, where the big competition is. So by and large, people that are in the luxury, rehab space, if you will, are dealing with kind of a lower end model. They're dealing in kind of a churn and burn, more affordable housing model. Whereas what I do is it's really counterintuitive. I go after the high end, the luxury houses. I've got no competition. People are not buying houses at this level. They don't have the capacity to do it at this level. They don't have the experience and the operator's experience to do it at this level. So, I'm looking at the tea leaves all the time and looking at what real estate is doing. And I just happen to live in a phenomenal place for luxury real estate in Ponte Vedra Beach. I'm at my house down here right now in West Palm Beach, which is going to be an emerging market for me where I'm going to start doing these same types of deals. But I don't have competition. So I'm looking for areas where I can make money in real estate, where I'm not banging my head up against the wall, competing with everyone that's been watching DIY or some sort of YouTube channel, and they think that because they've got a hammer and a screwdriver that they're a bona fide rehabber at this point. So eliminating that competition is critical. Operating in the right markets is critical. Operating in high-end real estate for me is really paramount to success, because a couple of variables that typically lower end or more affordable housing has come into play that don't exist in luxury housing. It's not an interest rate driven market. Most of my buyers are going to be cash buyers, so it does not necessarily, and there's exceptions, of course, but by and large, it's not tied into the overall economic state. So if the market's high, the market's low, interest rates are high, inflation's high or low, whatever the case may be, there's people in my space that have a lot of cash. They want to buy luxury real estate. And so for them, it's not a matter of, what the mortgage rates are at that given point. It's all about supply and demand. So I really play the supply and demand up big time. And in the luxury space for what I offer, which is a fully turnkey luxury move-in ready product, there is just not many, if any, of those out there in the markets that I'm operating inside of. So there's massive demand for them. There's people that have the money for them. People are not concerned with interest rates by and large, which definitely has a correlation with mortgage rates. And there's just not many of them out there. So when I do put these out on the market, and I do 10 to 15, 20 of these a year, which is a high volume in my space for sure, they go very quickly. So days on market is typically not something I have to deal with.
Price elasticity, and then again, like you were saying, they're not over leveraged too. They're very cash heavy. So I think this is important. You have that price elasticity because you have your cash. You're not stretched. Where if you're, again, back to the example that a mentor shared years ago with me of, you can either be a Nordstrom buyer or a Target buyer or a Walmart, right? Buyer. There's buyers in every store, and you as the business owner have to decide, well, which one do I want to sell to? I would say, like, when you get to the luxury kind of space and goods, not overstretched. In the middle, sometimes they're over clubbed and over leveraged because of the financing that's involved, right? So you see a pullback much quicker there. I am not, looking at real estate every minute of the day, but I do dabble in it because I'm very interested by it on a weekly basis. And I've even seen, like, even in my area, you start to see housing, single family housing in the middle pull back a little bit. Yeah. Because mortgage applications are down. And of course, all of these things are leveraged. And then of course, in the luxury space, there's not been any change. Actually, you've seen increases in pricing because there's so much demand in the area that I am, and people competing are all cash buyers, right? So it's fascinating to see the massive differences at where you play as a business owner and an investor.
Yeah, and you hit the nail on the head right there. There's such a splintering in the market between the luxury space and what would be considered, more affordable housing. Down here in Florida, for example, and where I'm at in Palm Beach County, just here's some data points. So just in 2025 so far, year over year, affordable housing has stayed fairly stagnant. It's even been reduced a little bit as far as the number of sales, whereas luxury housing, which would be considered here anything over $1 million, is up over 60%. So that goes to show you right there where, even if there's some kind of downturns in more affordable housing, the luxury space just continues to keep booming. And that's what I'm looking at. I'm looking at market analytics. I'm not just throwing a dart at a dartboard and saying, hey, I think this is going to work anywhere USA, because that's not the reality. I just happen to live by design in areas of Florida where they're very affluent. There's a lot of cash. There's very, very low supply of what I offer, what I ultimately bring to the table, and extremely, extremely high demand. So when it checks all those boxes, that's a market that I'm excited about. I talk to a lot of folks, and when I'm doing these podcasts, I communicate directly with people that have an interest in getting involved, and they say, is this something I can do in my backyard and, kind of Timbuktu, USA? And I always say, look, you've got to really take a hard look at the tea leaves. Florida is a booming market, especially the east coast of Florida. So I operate in Northeast Florida. Kind of the closest metro would be Jacksonville, down to Fort Lauderdale, and West Palm Beach would be in between. But those areas are only spiking at this point. So I would always say massive, massive caveat, because people say, well, I can do what you do, where I live. That is, I would say pump the brakes on that, do a ton of market research, follow the data, and then make an informed decision.
Yeah, the Ponte Vedra Beach and West Palm Beach, those are two of the most affluent areas in the entire United States, not just, on the on the East Coast and Florida. So there's a massive demand over there. For folks that are not familiar with your lending model, can you just give an overview of how it works and what you do and how, how,
Sure.
yeah, how investors have worked with you?
Yeah, so when folks come in, and when I do a podcast like this, they just go to our website. It's preferaccess.com. That allows them to fill out their information. I actually have a personal call with every individual, kind of get their backstory, see what their investment goals are. But to get involved is much like a syndication model, and a lot of folks come to us having done syndication before. There's some massive, massive distinctions. So in syndication, and some really good distinctions. I wanted to put this model together as an investor and for investors. So what I look for when I'm going into an investment deal, and that's what I offer. So most syndication models are 2, 3, 4, 5 years. The money's kind of stuck, whereas mine are project driven. So most of my rehabs in this luxury space fall somewhere between about 6 and 10 months. So a year or less is typically how long they're keeping their money in the projects before they get their returns out. They get collateral. So in a typical syndication model, and there's definitely some exceptions out there, they're not collateralized by anything. So, if a deal completely falls apart, they've got zero recourse. Whereas mine, I'm giving them collateral in the project through the way of a promissory note and a securities agreement. That securities agreement has a lot of teeth to it by design. I'm basically handcuffing myself, because that allows every preferred lender that's getting involved in these projects to file what's called a UCC1. That UCC1 basically is putting a lien on the project, making it so that I cannot complete the project and sell it without paying every one of those UCC1 filers. So people say, how is their money safe? That's exactly how it's safe. So first and foremost, it's a shorter period of time than syndication. Secondly, they've got collateralization, which I'm not familiar with many syndication models out there where you're getting collateral. Number three is there's not a dilution model. So they're not getting, let's say I've got a project that I'm projecting to sell based on third-party appraised value after the rehab for $5 million. I'm just using a round number here, but those are typical exit prices for me, 5 to 6, 7, $8 million. And I sold for $500,000 less than I anticipated. And there we're getting let's call it a 25% cash on cash rate of return. Just because I'm selling it for less, or if I sell it for more, they do not make more or less on their initial investment. They're locked in and they're collateralized by that hard asset. And then what people love is that it's passive. It's 100% passive. So they're putting their capital into it. They've got the collateralization. They know it's going to be in that 6 to 10 month range. And regardless of what I sell the project for, they've got a locked in rate of return.
Gotcha. And then how you find the properties, can you give a little bit of an insight of
Yes.
how you go to work and make the magic happen?
Yeah. So I'm shockingly enough, I can find these projects, excuse me, Shockingly enough, I can find these projects just on the open market. I can find them on Zillow. Some of them are off-market deals, but for me, it's all about making the math make sense. So I'm looking at houses that are great houses in great neighborhoods. They have good bones to them. They just haven't been updated in 5, 10, 15, 20, 25 years. So I know I'm going to be able to get them at a discount. I know based on what that scope of work is going to be, how much money I'm going to have to put into each project. And typical range of a rehab budget for me is somewhere between about 600,000 and about 1.5 million. I do also do some tear downs and new builds. You know, it's the land is worth more than the house, so I'll tear that down as well. But I need to be able to buy a house, add the rehab budget to it. And then what I'll do is I'll bring in a third party appraiser. So not someone on my team, it's someone that's coming in, a professional appraiser company. I'm giving them a scope of work. I'm in a design book. I'm saying, here's exactly what I'm going to be doing to this house if I were to move forward with it. Assuming all of these things happen, what is this house going to be worth? They're going to take comps in the area of rehabbed houses. They're going to utilize my design book and my scope of work, and they're going to give me back a number. I need to be able to take that appraised value, reverse engineer the math, and buy it for less than 65% of what it's going to cost me to purchase the home and add that rehab budget to it. So, and I always share that very openly, how I do the math on that, because that 35% gap, allows me to give high rates of return, which people always ask, you know, how are you giving out 20, 25, 28% cash on cash? Because I'm buying them right. It all starts with the purchase. And if I'm not following my own math, that's when mistakes happen. So I don't deviate from that math equation whatsoever, but I'm using a third party to let me know what that after repair value is going to be. And only if it falls within the auspices of that 65% or less am I moving forward with a purchase. But I've got a great relationship with luxury realtors at this point. They're feeding me deals. Again, I do find some off market, some on market. So it's kind of a mixed bag of how I come across them, but it all boils down to the math.
And then your team comes in and then does the renovation and then puts in all high-end fixtures and appliances and that kind of stuff, right?
Yeah, that's exactly right. So I've got my own construction team that comes in. They handle 100% of the oversight on the project. I am the operator. So one of the biggest things with my model is that I'm boots on the ground. You know, these are not projects that are halfway across the United States. And I'm hoping and praying that things are getting done every day. I'm not the one swinging the hammers, but I'm the one watching them swing the hammers each and every day, and obviously staying on top of each one of the projects. But they're going in, they're doing the rehab, they're following my scope of work, they're following my design book. We do not spare expenses on fixtures and finishes. My appliance packages alone are, twin sub-zero in the kitchen with Wolf or Viking ranges and appliances. So my appliance packages alone in the kitchens typically are between $70,000 and $90,000. So when potential buyers come in and they're looking at a finished product and they're seeing this guy put in $80,000 just in appliances in the kitchen, it gives them a pretty good indication that I'm not cutting corners on the rest of the house, which I don't. At this level, you can't.
Right. Right. And this is also, again, compare this to the just the average market, in construction. That is one of the complaints of, houses these days that are a lot of these new builds. I mean, it's just, I'm going to say this very nicely. It's not like the houses that they've built in the 1980s and 90s, right? Or even the early 2000s. The quality has gone down significantly.
No, it definitely has, and that's one way where one of the areas where we don't cut corners. I do have a specific budget, so I'm also not into doing cost overruns, but I don't cut corners on quality, period. Crown molding across across every room. It's going to have the appliance packages I'm talking about. We're ordering high-end, light fixtures. I mean, I'm doing a house right now that's got a $30,000 chandelier in it. We're doing marble floors. We're doing marble countertops, doing LED mirrors in each one of the bathrooms. So expenses are not spared there at all. And that's where you make your top dollar. If I could go in and buy these same houses and come in with Z-line appliances from Home Depot, and they would be presentable and they would show okay, but I'm also not going to get at the top of the market with those. So I want to make sure that I'm using only the premium quality fixtures, finishes. All of those are going to be high end, and I don't spare any expenses there. I mean, my average rehab budget is going to be plus minus $1 million. That's a lot of money to put into a house, considering they're not in bad shape. These are not houses that are falling down. They just simply need updated. And I'm
Yeah.
spending a lot of money to do so.
Yeah, that and you know it's interesting. Having looked at a number of places over the past year or so, that is the big thing, the updating that's needed.
Mm-hmm.
Um, how long does a cycle take, more or less, of from like start to finish, from finding a deal, it makes sense, and you're moving on it to the completion of
Yeah,
of exiting it?
so typically it's about a plus minus 8 to 10 months. They can happen sooner than that, but as far as documentation goes, when folks come in and they want to be a lender on one of these projects, the documentation is going to say 10 months. And we would rather have people be happily, satisfied when they get done sooner than that. But anywhere from on the low end, 6 months, on the high end, 10 months. Some have taken a little bit longer than that are bigger projects. Keep in mind, most of these houses, we're taking them down to the studs,
Yep.
and these are 4, 5, 6, 7, 8,000 square foot homes, big time estates. So, again, we don't breeze through the work just to get them done quickly. We want to make sure that the quality is ensured along the way. But long answer to your short question is I typically say if you count on about 8 months, it's going to be maybe a little bit longer than that or a little bit shorter than that.
Gotcha, gotcha. And what's the activity like in the luxury space currently? We're pulling up here in the fourth quarter of 2025. What does it look like in the markets that you operate in? What are you seeing?
Yeah, so the finished products are getting a ton of good response, a ton of good feedback. The great thing about operating in Florida is it's not as seasonal. Of course, during the summer it can slow down a little bit because in these markets that I operate in, people do vacation. They've got secondary homes, for example, and they don't want to be in the blazing heat. Or depending on what school schedules look like. But it's not like the North or the Northeast where real estate really slows down when it gets to the winter months, which can last. And I know in your neck of the woods, those can last, 4, 5, 6 months at a time, depending on, if it's a brutal winter or not. But the reality is that it's a hot market. It continues to heat up. Again, it all boils down to supply and demand. So when people that are in the market or don't even know they're in the market, but they hear of or they see one of our houses hit the market and they're sitting in a house that, is maybe 10, 15, 20 years outdated, they get in the market very, very quickly. So our houses just don't sit long because there's just no competition. There's no other supply of them out there.
It's interesting. So are a lot of these buyers, are they local in their markets? Are they people that move there? Are they overseas buyers? That's a good question too for Florida.
No, totally mixed bag. So a lot of them, of course, are local. I work exclusively with a couple high-end brokerages, Berkshire Hathaway for one, Sotheby's for another. They do a lot of marketing in the Northeast for us. So people that are going to be snowbirds. We do get buyers from overseas that are buying these houses sight unseen. I mean, the great thing about Florida is it's got some massive benefits to buying real estate over here. I mean, there's no state income tax. It's extremely business friendly. So if you're an entrepreneur looking to move down to Florida, you've got a very business friendly climate. There's exceptions for reduced property taxes, and you cannot beat the weather. So if you're looking for a combination of a good investment market and kind of a luxury lifestyle market as well, it really does check all those boxes. So all of the above would be the answer to your question. We get locals, we get people from other areas in the United States. I mean, there's a mass migration from places like New York and the Northeast moving down to Florida, seeing New York license plates every day. Another story for another day, but they're moving down for a handful of reasons. Some of them are political, some of them are simply financial. The tax burdens that they're dealing with in states like New York and New Jersey right now are really forcing a lot of particularly business owners and entrepreneurs out of those areas, and they're coming down to Florida. And for what they can get here, for what they would have paid up there, they think that they're stealing these houses, which is, it's really cool to watch. But and then of course the overseas buyer, for the reasons that I just shared, they're buying a lot of these houses sight unseen.
Yeah, there's a lot of folks from Latin America too, from overseas
Mhm.
buyers in there, Argentinians and so forth. I mean, it looks like they bought a lot in Miami and then they're moving up a little bit further north, right?
Getting a lot of that actually, because Miami has gotten so expensive and so overpriced. Now people are starting to move up that East Coast. They're moving into Fort Lauderdale. They're moving into West Palm, which last time I checked, West Palm Beach, where I'm at now, is I think the number two or number three hottest real estate market in the country. They're moving a little bit further up, which is about 4 hours north to where I live in Ponte Vedra Beach, also. Which the closest metro to that would be Jacksonville, which is another just absolutely on fire luxury real estate market. So they are, where it used to be Miami was the hottest spot in Florida. A lot of people that were looking there or maybe can't afford or they want more bang for their buck are starting to move up the coast.
Yeah, it's interesting because I remember in 2020 how that exploded and people moved
Mhm.
down there, and
Yeah.
then all of a sudden, they're starting to creep up. What are some of the other things that you're seeing there that is affecting or could impact your strategy, positive, negative? What are some of the things that you're keeping an eye on?
Well, I'm always taking a look at population. Again, it all really is always going to boil down to supply and demand. In the markets that I operate in, is there an overabundance of luxury housing? Is there an underwhelming amount of volume for people that can afford these types of houses that they, assuming that they're turnkey, move-in ready, which is what I offer, that they would be able to come in and scoop up. What I don't want to do is be in a market that's oversaturated with luxury housing. And unfortunately, I'm not in that situation. I'm not aware of any markets in the country that are oversaturated with what I offer. But that being said, those things would definitely be tea leaves that I'd be reading day in and day out. The population is always critical, so I'm looking at population booms that are happening in the markets that I operate here down in Florida. There's similar markets around the country: Nashville, Tennessee, Austin, Texas. People that are leaving Florida or leaving California, for example, or they're leaving New York. They're looking for, tax benefits, tax advantages, less taxes, and a little bit more of a better kind of lifestyle change.
Interesting, interesting. And then, Michael, this has been fascinating, and great to get an update to see how this is going because I know this strategy was going gangbuster. So it's interesting to see that it continues to do that, and you're moving into another market. So, other potential markets eventually besides these two on the horizon.
These are going to be the next two up. I do like Fort Lauderdale. I don't intend to have a house down there. So at this point, I'm only operating in markets where I actually have a residence and I can be boots on the ground. So Ponte Vedra Beach was the initial market and one that I've been operating in for a while. West Palm Beach actually just got a residence down here about 30 days ago, with the sole intent to start buying real estate down here. I'm looking at potential real estate deals down here every single day at this point. So between those two, I can really do a heck of a lot of deals. I am looking to scale, so scalability for me looks like, maybe 20 to 30 deals a year. I don't ever want to be some monster that I'm doing triple digits each and every year. I think that the only thing worse than no growth is hyper growth, so I want to be cognizant of the fact that I want to be able to maintain inventory. I want to be able to keep, my boots on the ground, my eyes on each and every one of these projects, which, just being the operator, I think is where a lot of people can fail. They want to get into real estate. They'll pump money into real estate. They either don't know how to be an operator or they've got a bad one. When you start out there, things can go south very, very quickly. Your financial exposure and the likelihood of failure is going to skyrocket. So I really want to be careful with my growth. But to answer your question, at this point, Ponte Vedra Beach and West Palm Beach, Florida.
Yeah, I think this is another good business lesson for folks too, because I just did the math. Even if you just do 20 of those
Mm,
and it's around 5 million that's
yeah,
involved in that's $100 million of real estate that
yeah.
gets moved. And it's like, do you want to do that with 20 deals or do you want to do that with 200 deals? Again, with the space that you're in, you could do it with 20 deals rather than 200, right?
Yeah, I would take the 20 deals over 200 deals all day long. I mean, just the likelihood of things going south on 200 deals is going to be much higher than on 20. I don't have the I don't have the manpower and I don't have the bandwidth nor the desire to do 200 deals at this stage in my career. But, in that 20 to 30 range is where I'm really comfortable right now.
Awesome. Well, this has been great to catch up, my friend. Where can folks contact you again and reach out if they want more information and just follow you?
I've got a website and they can look at active projects out there. I break down all the deals. I do a weekly update video to everyone that's involved in projects, or even if they're not, if they're just in the database and they want to see what's going on from one week to the next. So every Friday or Saturday, I'll put out an email to the entire database that shows progress videos on each project. It'll give line item details on what's going on. So from one week to the next, they're never going to have to wonder what's going on with their project or other projects that are in the active portfolio. But they would simply go to Prefer Access, so just PREFER access.com. There's going to be a contact link on there. They fill out their information. That gets submitted directly to me and my team. And I make a personal phone call. So everything starts off with that individual phone call from me, answering any questions that they may or may not have, answer any questions that they may have, kind of giving them the chronology on how things work. They get to take a look at sample documentation. So if they were to get involved in a deal, what would they be signing off on? And a complete breakdown mathematically on every project that I've got out there. I do also have a 10-month note fund. So people that want a specific time frame for expiration and they know at 10 months, which is the term, the maturity term of the note fund, they know at that 10-month on the day they're getting their payoff as well. They are again collateralized by the two hard real estate assets. So and anything that they're going to be doing with me, they do have collateral, which helps people, kind of sleep, comfortably at night. But preferaccess.com is going to be my website, and it breaks down all of this information.
Awesome. Well, thank you so much, Michael, for coming back on the show. And as always, providing so much value to all of my listeners and my viewers.
No, I appreciate you having me back on here. It's been a handful of months, and I love talking to your folks. So, hope to hear from some of them and get them actively involved in some of our deals. But always appreciate your time, brother. You're just a wealth of knowledge as well. So I love just kind of trading back and forth on what each other are up to.
And thank you to all of my listeners and my viewers for, again, spending your most valuable resource, your time, once again with me on the show today. Everything Cashflow Ninja is at cashflowninja.com. We've got over 1,000 podcast episodes. There's 4 books, there's reports, there's webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Until next time, live infinitely.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.